Warm welcome to CA Raja classes and thank you so much for joining this mini and micro webinar. Before we get into the discussion, let me just take a couple of minutes to introduce myself. I am CA N Raja, a chartered accountant by qualification, a teacher and trainer by passion, and teacher for 3 lakh plus students worldwide. I started my career as a banker with State Bank of India. Then after a period of 4 years, I got into CA practice. I had my practice for 7.5 years. But I realized my calling is teaching. I started focusing on teaching and training, and today with the blessings of God, we have 3 lakh plus students worldwide. So now it's time for us to get into the session.
Capital financing. Let me start with a basic question. Why business fail? Please give your answers. Business can fail on account of marketing, on account of competition, quality issues, R&D, not doing enough R&D, then not keeping themselves updated with the technology, HR issues, pricings, even legal issues. But what was understood is all these reasons put together constitutes only 5% as a reason for failure of a business. It means the remaining 95% is on account of one single reason that comes from financial mismanagement, and that is mostly related with working capital. That is, entrepreneurs, they do not understand their working capital, they do not differentiate working capital funds, they make wrong usage of that. Okay, so in that context, working capital funding gains significant importance. Okay, so what is working capital? Let's try to understand. Let's say you start a business. That business requires an investment of 10 crore. And let's say you have that money and use that money for purchasing land and building 4 crore, plant and machinery 5, furniture and fixture 1. So what's the total? The total is 10 crore. So these are all the assets of the business. And for that you have brought in capital of 10 crore. Okay, this can be termed under the head equity, and traditionally when we prepare the balance sheet we say equity and liabilities. Okay, so even though on the left you see as liabilities, it should be read as equity and liabilities. And let's total both sides, 10 crore, and you can see the total is balancing both sides, and so we call this statement as a balance sheet. So now we started with an understanding that you have 10 crore and you have used that 10 crore for acquiring various assets for your business. Okay, it means you have state-of-art infrastructure, all this, and let's say your first customer walks in and he is placing an order. The question is whether you will be happy about this. If you are not happy, why? The reason can be you have used all the money for acquiring long-term assets. It means you don't have money to acquire raw material now, you don't have money to pay salary to your employees, you don't have money to carry out your production. This can be compared something similar to this. Let's say you want to buy a car and use it for say taxi business, but you don't know how to drive, you want to engage a driver, and you have 10 lakhs with you, you purchase the car, and you don't have even 100 rupees extra to fill a fuel, and you don't have money to pay salary to the driver, assuming that driver insists salary upfront or say on a daily basis. Okay, so if you don't spend that small amount on fuel, or if you don't have enough cash to pay your driver, this asset, the car, will become a dead asset. It will not generate any revenue for you. Same is the case of all those long-term assets. Those long-term assets will not generate any revenue for you unless and until you bring in sufficient working capital and invest on the required elements like raw material, in this case fuel, employees, in this case driver, and like that you will have various other direct and indirect expenses. Okay, so the money which you bring in to ensure your business runs on a daily basis, we can term that as working capital. So working capital is the capital required for daily working of business, right? And let's say now you got that realization that it is not sufficient to invest on fixed assets alone, long-term assets alone. You should also invest on raw material. You should also invest on people. That's your employees. Okay, so let's say you have managed to bring in some additional cash. Not only the 10 crore which was originally invested, but you are also bringing some additional cash to support your working capital. But here also we should know what is that amount of cash required to ensure day-to-day operations happens without any issue. Because when you bring in cash, first let's say you put that cash in purchasing raw materials. For how many days you will purchase raw material? Is it for your 1 day requirement? Is it for 1 day production? Or is it for a weekly production requirement? Or are you going to purchase and stock raw material for your next 3 months requirement, 6 months requirement? It all depends upon the kind of business you are into. It all depends upon the kind of raw materials market, availability, the demand for your final product. Okay, so there is a separate section called inventory management. And based on that, only business can take a decision how much of raw material they have to purchase and keep on stock. Because there is a storage cost, we call it as carrying cost. Okay, then there is an opportunity cost because your money is getting locked in the inventory. On the other side, you need money to run your business. Okay, so there is a carrying cost, there is an opportunity cost. You have to keep all those costs in mind, and only then you have to come to a conclusion about the number of days of raw material you have to keep in stock. Then you take them for production. We call that as work in process stage. And this work in process can be a simple process wherein you put the raw material into the process, you get the output within a matter of 30 minutes, or it can be a very complex, detailed, elongated process where it can take like 20 days, 30 days to get your raw materials converted into finished goods. So in which type of process? That again depends upon the technology you have. It depends upon the nature of the product as well. Okay, right. Then when it becomes finished goods, okay, that is when the production is completed, you get your finished goods. But all the finished goods will not get sold immediately, right? Because you have to do the display, you have to take it to various locations. Sometimes it will be lying in godown. And if it is made to order, then yes, immediately it goes out. But if you are producing the goods in anticipation that someone will come and buy, then you have to do a lot of marketing to ensure those goods are getting sold. So what's happening in all this? The cash what you have invested in raw material got locked in raw material for some days because they have to keep it in godown to meet their production requirement. Then it goes into the production process, and if the process is complex, then again it's getting elongated, and when it had become finished goods, it is not getting sold immediately because it's either sitting in the godown in anticipation of some buyers, or it is in display that on the belief that someone will come and buy. Then let's say somebody has come and purchased the goods, customers. In case of say business B2B, most of the purchases will happen on credit terms. It means even when you identify the customer, you are not going to get the cash immediately. It's going to take time. And let's say the customer pays you after some point of time, you get back your cash. So look, the cash what you have invested in your business, you started with the purchase of raw materials, but in order to get that cash back into your hands, it has to undergo various stages. Cash will become raw material will undergo production will become finished goods, then it should go to the hands of a customer, and customer will eventually pay. And let's say your business demands or your business model insists that you maintain at least 30 days of raw material. Then the cash what you put into the raw material holding is locked for 30 days. When it is taken for production, let's say the production process is 15 days. It means the cash what you have spent on the raw material plus some more additional expenses because you have to pay your employees. You have to incur electricity cost, you have to incur fuel cost, various other direct manufacturing expenses in the production process. So not only the money that was spent on 30 days is locked for another 15, that is 45 days, but you also spend something more. So for 45 days your money is locked, and then it had become finished goods, but it is not getting sold. Let's say the finished goods are going to lie in the godown or in display or in shop for another 15 days. It means for 60 days your money is blocked. Then it goes to the hands of the customer, and let's say the customer is taking another 30 days to pay you back. It means the cash what you have spent is going to come back to you only after 30 plus 15 plus 15 plus 30, 90 days. So for this 90 days, how are you going to manage the show? Because whatever you had invested, how you will manage the show? That's where working capital, bankers, financiers, everyone will come into. So let's digest this. You invest in raw material, so you go cash dry. Then you have to invest in production, again you will go cash dry. It will become finished goods, you are not getting money. It is sold to customers, still you have not received money, and only at this point you are collecting money back. It means when you invest in raw materials and when you go cash dry because you are not in a position to say go to the next level, that is for the production, or when you invest in raw material and if your business process insists that you have to purchase raw materials in some other short interval, how will you manage? Because whatever the money you have, you have invested in raw material, and what is left over with you is only available for meeting the production. How you will ensure your second purchases happens without any difficulty? So at this point, you need someone to give you cash. Okay, let's say the money what you had reserved for production is invested in production, but the production should happen on a continuous basis. So you cannot go dry. So even at this point, you need cash, and your money is now logged in finished goods. You need some cash. Your money is logged with a customer. You need some cash. So like this, in each and every stage when you are investing your money and when you are going dry, if some other money comes and supplements that, ensures that you are breathing always, then that money becomes a savior. Okay, so that's where, as I mentioned earlier, working capital financiers comes into picture. So let's digest. You are going to invest in raw material, work in progress, finished goods, receivables, and all these. I mean, what is the uniqueness of all these assets? All can be converted into cash within a period of 1 year or within its operating cycle. So we call them as current assets. And how you are creating these current assets? You need source of funds, right? For that, the sources can come from suppliers. Supplier can give you raw material on credit. Okay, so you are getting some source. The source can come from banks. Banks are ready to give cash credit, overdraft, to help you to build up your current assets, to meet your working capital requirements. So these sundry creditors, banker funds, all these are short-term funds, so we call them as current liabilities. So look, you have more of current assets, and some portion of current assets are funded by current liabilities. It means there is a residual portion of current assets that should come from long-term funds. When I say long-term funds, it can be a combination of owner's money and long-term borrowings. Okay, so let's put that. Current assets can be funded, number 1, by owners, okay, number 2, by suppliers, number 3, by creditors, and number 4, by bankers. And bankers, they do it in two forms. 1 as fund-based facility, 2 as non-fund-based. Fund-based facility can be in the form of cash credit overdraft, and non-fund-based facility can be in the form of letter of credit, bank guarantee as well. Okay, let's see how the assessment part is done. Because now we have understood that bankers will give fund-based as well as non-fund-based. And I mentioned cash credit and overdraft. Okay, so how banks are doing this? Let's see. See, this assessment of fund-based working capital requirements can be done using 3 methods. 1 is turnover method, 2 is maximum permissible bank finance method, and 3 is cash budget method. And here I am not going to discuss about cash budget method. We will focus on the first 2, turnover and maximum permissible bank finance method. Okay, this turnover method, that is method number 1, is very simple. So this is the method prescribed by NAIC committee. Okay, we use it for small business entities. As far as the limits are concerned, I request you to check up with your latest bank norms, because the changes are happening. The changes in definition of MSMEs takes place. So I am not mentioning any limit here. Okay. So what this NAIC committee method says. As per this method, the working capital requirement of any business is 25% of the turnover. It means 25% of the turnover is considered as current assets. Okay. Of which how much can be funded by the bank? Look, 25% of the turnover is the working capital, gross working capital, so we call it as current asset, of which 80% can be funded by banks. It means 80% of 25, that is 20% of the turnover can be funded by banks, and that's why you see most of the banks, when they estimate cash credit limit as per my committee, they simply estimate it as 20% of turnover, which is nothing but 80% of 25% turnover, because 25% turnover is considered as gross working capital. So what that means, the remaining amount should come from owners as margin. It means if 80% is funded by the bank, the remaining 20% should come from owner. So this 20% of 25 is 5%. It means 5% of the turnover should come as margin, and 20% of the turnover banks can consider funding. Okay. So why this logic of 25% turnover? See, 25% into 4 times makes 100. It means it's basically the 4 cycle of 3 months each. So Nayak committee method assumes that the working capital cycle of a business is 3 months. So there can be 4 cycles, and for that this is the level of credit. But again, this is only the minimum level of credit, because for some business this level of credit may not be sufficient, and in those cases banks, they can take their call. Let's take a small case study to understand the numbers. Look at this. The estimated turnover is 300 lakhs. We have to compute eligible bank finance under turnover method, that is Nayak committee. So how we do this? Your estimated turnover is 300 lakhs. So what is the gross working capital required here? It is 25% of turnover, estimated turnover, not the audited one. Okay. It is 300 into 25%, 75 lakhs is the working capital requirement, of which 80%, that can be the bank finance. So 80% of 75, or it can be simply 20% of the turnover. So either case it is 60 lakhs. It means the remaining amount, 75 minus 60, 15 lakhs should come from owner as working capital margin, and this 15 is also a result of 5% of turnover. Okay. Let's take one more case study. It's a detailed one. You have following information. You are given sales for 3 years, 2017-18, 18-19 and 19-20. Figures are in lakhs. Okay. Estimated sales for 2021 is rupees 200 lakhs. Item B. Bank has a practice of finalizing estimated turnover by selecting lowest of, underline, selecting lowest of turnover estimated by customer, 25% growth over previous year, and average growth over previous 3 years. See, this is very important, because here we are saying the working capital requirement is 25% of turnover, right? 25% of what turnover? Estimated turnover. So estimated turnover means the turnover can be estimated by the customer, but that should also be acceptable for the banks, right? So banks will be having a policy on selecting an amount for estimated turnover. Otherwise, if they are going to simply rely on estimates given by the customer, then it is possible that sometimes it could result in excess funding. So bankers should also relate that with reality, relate that with what is happening now. So banks can have different policies, and the example what we have taken, this bank has a policy of finalizing the estimated turnover by considering the lowest of turnover given by the customer, 25% growth over previous year, average growth over previous 3 years. Let's see what are all they. Okay. And it does not end here. You have to compute eligible cash credit limit if either of the following security is offered. If the customer is offering land, the value is 50 lakhs and the LTV of the bank is 50%. If the customer is offering self-occupied residential building, the value is 38 lakhs only, but LTV is 100%. Commercial building, it is 35 lakh and LTV is 90%. Okay. And how they are sanctioning the limit? They are sanctioning the limit as the lower of turnover based limit, loan to value limit. Okay, let me just summarize this. You have 3 years sales information. You are also given what is the estimated sales. and you are given what is the bank's practice, how they finalize estimated turnover. You are given information about the collateral security that is available. So 3 different collateral securities. So for the customer to get the best of loan, which security they have to offer, and how the bank is sanctioning the limit, because they are not merely looking at turnover, they are not merely looking at security. They are actually combining, and in that whichever is lower, based on that only they are going ahead with the sanction. Okay, let's proceed. So first what we'll do, we'll capture the information. We have year 1 sales 80 lakhs, year 2 100 lakhs and year 3 130 lakhs. Year 4 is what we have to estimate, but for that we have 3 guiding factor. So number 1 factor is estimate given by customer, which is 200 lakhs. The second factor is 25% growth over previous year. What is the previous year? Previous year, how much? It is 130. Okay. So 130 plus 25% will give you 162.5. So this is what 25% growth over previous year, which is 130 plus 25%. The third factor is average growth over previous year turnover. So we have previous 3 years. So we have to see what is the average growth. So from 80 to 100, what is the growth? It is 25%. From 80 to 100, there is a growth of 20 lakhs, which is equivalent to 25%. From 100 to 130, there is a growth of 30 lakh, which is equivalent to 30%. And we will take the average of this. 25% plus 30% divided by 2, you get 28%. So it's actually a rounded off figure. So you apply this average growth on this 130. So 130 plus the rounded off figure of 28%, you get 165.75. Okay. Now what is the practice of the bank? Bank will compare all the 3. In that, whichever is lower, they will consider that as estimated turnover. So here the lowest is 162.5. That is the estimated turnover. Okay. So as per estimated turnover, their eligible CC limit is 20% of estimated turnover. That works out to 162.5 into 20%. It is 32.5 lakhs. Okay, so this is one limit as per estimated turnover. Let us also see what is the limit as per available security. So what are the security? The first security is land of 50 lakhs. And what is the LTV permitted by the bank? Loan to value, they permit only 50%. So 50 lakhs worth of land, but bank will consider only 50%. It means 25 lakhs. And what is the limit based on turnover? 32.5 lakhs. So what is the eligible limit? Whichever is lower. 25 lakhs is the eligible limit. Next comes the self-occupied residential building. The value is 38 lakhs, and since it is self-occupied residential building, there is a lot of sentiments attached to it. So bank is ready to consider up to 100% LTV. It means loan to value will be 38 lakh into 100%, 38 lakhs. Whereas the limit based on turnover is 32.5 lakhs. So whichever is lower, 32.5 lakhs will be the eligible limit. Then comes the commercial building. Commercial building security value is 35 lakhs, whereas LTV, bank is ready to consider only 90% of it. It means LTV is going to be 31.5 lakh, and limit based on turnover is 32.5 lakh, and in that whichever is lower, 31.5 lakh. So the eligible limit will be 31.5 lakh. So which property he should offer? He should offer a self-occupied residential building, and in the company whatever, so that they get 32.5 lakhs as eligible limit. Okay, let's move on to the second method, that is the tandem committee method for financing working capital requirements. As per this method, working capital credit assessment is actually linked with the level of operations and activity of enterprises. Okay, here promoters are expected to bring minimum margin for meeting the working capital operations, and banks are expected to fund only the residual portion, Even earlier there were standard norms like how much of raw material have to be maintained, how many days of production, but now that is permitted. I mean, banks can go on case-to-case basis approach. Okay, how this model works. See, this maximum permissible bank finance method or model has 3 methods, of which what is widely used is the second method, and the third method is not an operational. I will show you all the three, but we'll discuss only about the first and second method. Okay. So in first method, this current asset is the gross working capital for which funding is required. A portion of current asset will be funded by other current liabilities. It means there will be a gap we call as working capital gap. And how this working capital gap have to be funded? What this method says is, this gap has to be funded by two sources. One by owners by way of margin, two bank can fund the residual. So how much owners are expected to bring in? Owners are expected to bring in 25% of working capital gap as margin, and balance can be brought in by the owners. This is what first method says. Whereas second method is different, and this is what widely used in banking. You will see this in most of the banks. Here this method says the current asset is funded by a portion of, the portion of current assets is funded by other current liabilities. It means there is a gap, and that gap have to be funded by owners, and balance can be by a bank loan. But how owners should fund this differs from the first method. First method says it is 25% of working capital gap, whereas second method says it is 25% of current assets. It means this puts more burden on the owners to bring in margin when compared with the first method. Because in first method, this 25% is applied on gap only, working capital gap. Whereas here it is applied on total current assets. So as a result, the margin will be higher, and the bank loan eligible cash credit will be lesser when compared with the first method. I'm not even talking about the third method. Let's skip that. Through a small case study, I'll explain this. You have the following information. You are given current assets, current liability. Okay, this core current asset is actually related to the third method. Since I'm precluding that from the discussion, I'm not focusing on that. Okay, so you have current assets of 100 and current liability of 40. So when I say current liability, these are other current liabilities. It means it's a current liability other than bank borrowings. Okay, it is not mentioned in the screen. I am stressing on that. It is current liability other than bank borrowings. You have to compute maximum permissible bank finance only as per the first and second method. Presentation says 3 methods, but we'll do it only for 2 methods. Okay, so this is how the structure goes. I'll explain one by one, worry not. First method, we said current assets, let's say it is 100 million. From that we have to deduct other current liabilities. In the case it is mentioned as 40 million. It means there is a gap of 60 million. So what this communicates, of this 100 million current assets, funding had come from current liabilities, other current liabilities 40 million. It means there is a gap of 60 million. And here the core current asset does not arise. So as per first method, owners have to bring in margin, right? And they have to bring in at the rate of 25%, but this 25% is applied on working capital gap. So 25% of 60 gives you 15. So 60 minus 15, the balance is what bankers are permitted to fund. So 60, okay, minus 15, bankers can fund up to 45 as cash credit. Okay, this is as per method 1. And now let's try to calculate the current ratio. Current ratio is basically current asset by total current liability. Here current asset is 100. Current liability is this 40 plus this 45. So 85. Okay. So 100 divided by 85. So what is the current ratio now? Current ratio it is 1.18. Under second method also, the current asset is 100 and other current liabilities are 40, so the gap is 60. And now the question is how the margin have to be calculated. In second method, the margin of 25% is applied on total current assets. So this is total current assets, right? So it is 100 multiplied by 25%, so the margin is 25. So 60 minus 25, what is the maximum permissible bank finance now? It is 35. It means the eligible bank finance comes down in second method. So what is the total current liability now? It is this 40 plus 35, 75. So 100 divided by 75, and this gives you current ratio of 1.33. This is something which you should be able to relate with our rationale also, why banks are insisting on current ratio of 1.33, because that means there is a 25% contribution for creating the current assets. Okay. The third method, as I said, it's not relevant. I'm not going for that. But third method is even more stringent. It reduces the maximum permissible bank finance at it, and it increases the current ratio.
Thank you for watching this webinar. I am sure you have derived value from this webinar. And if you wish to learn more, I have some good opportunity for you. What is that? Check out.
It is this Credit and Financial Analysis Mastery course, exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course, you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you, it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over. You also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course, you will understand what is working capital, what are working capital credit facilities, and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course, you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis. Various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall, it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you, the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description where without using any discount coupon code you can enroll at this discounted price because it's a discount applied link. And not yet over, you are also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.